Hello, my dear students. I am Professor S.V. Shrimali from Department of Commerce, S.V.K.T. College. Today, we are going to talk on TY BCom paper number 5, Cost and Works Accounting 3. Thereunder, we are talking about marginal costing, chapter number 1. We have already taught about the different concepts regarding marginal costing, like what is meant by marginal cost, what is meant by marginal costing, what is the contribution, etc. Now, in the last session and in part 1, we have already talked about PV ratio, and in the part 2, we will talk about some more concepts in marginal costing. Now let us understand what was we have already taught, that is PV ratio, and in this coming session we are going to talk on break-even point as well as margin of safety. In the earlier sessions we have considered the meanings of marginal costing, thereafter what was the fixed cost, what was the variable cost, and how to calculate the contribution. So my dear students, for calculating the marginal cost, it is important to understand the differentiation between fixed cost and variable cost. As we have already taught in the first session about the meaning of marginal cost. So marginal cost is nothing but the variable cost. As in the concept of marginal costing, the fixed cost is considered as period cost. That means this cost is not considered while calculating the marginal cost. Hence, marginal cost or marginal costing can be known as variable costing. So, for calculating or for implementing this costing technique in your organization, it is important to know which are your fixed cost and which are your variable cost. Fixed cost remains fixed in total, but fixed cost changes in per unit. That means if the production increases by 1 unit, the fixed cost per unit will get increased. And if the production decreases by 1 unit, fixed cost per unit decreases. If in case of variable costing or in case of variable cost per unit remains constant, but variable cost per unit in total get changes. When any kind of production, any kind of volume of output get increases, the variable cost also get, total variable cost also get increased. And when the production level decreases, the total variable cost also get decreased. But it remains fixed in per unit. The examples of this fixed cost and variable cost are the rent, insurance, taxes, administrative department salaries, electricity in certain extent are the examples of fixed cost. And for variable cost, we can say that direct material, direct labor, direct expenses as well as variable overheads are the variable cost. So, while calculating the marginal costing and while calculating or while implementing these marginal costing techniques, the variable elements, that is direct materials, direct labor, direct expenses are important for the purpose of calculations. And all these totals known as variable cost, that means total variable cost. Now what is meant by contribution, that we have already studied. Contribution was nothing but the amount that will cover your fixed cost in the organization. It is not known as a profit because profit can be calculated only after deducting the fixed cost. But while calculating the contribution, we doesn't consider the fixed cost element. Hence, contribution is known as sales minus variable cost only. And to come at a profit, we will have to deduct fixed cost also. Hence, for calculating the contribution, only variable cost element is considered. So, sales minus variable cost is equal to contribution. In this way, we have learned already the concept of fixed cost, variable cost as well as contribution. Then we have already learned the meaning of profit volume ratio. Profit volume ratio, as the name itself indicates, is the ratio between profits and volume of sales. But here in our marginal costing, we consider profit as a contribution. Hence, the formula can be known as fixed cost upon PV ratio, and we can calculate as contribution upon sales into 100. Then what was the importance of this PV ratio? The PV ratio has some importance for the managerial decision makings. It is important for checking the profits of the firms, and it is important to check the productivity, profitability of the firm. It helps in inter-firm comparison, etc. We have also learned the meaning of fixed cost, and as well as according to that we have already learned the meaning of PV ratio also. So, PV ratio indicates that if the sales above break-even point are more, then the profit is more. And if the sales at break-even are less, the profit is also less. We have already studied the formulas related with the PV ratio, that is contribution upon sales into 100. There are another two formulas also, that is change in profit upon change in sales into 100, and again there can be change in contribution upon change in sales into 100. So according to the example you have to apply the formula. We have also learned the example for calculating the PV ratio, and we have calculated the PV ratio of 20%. So the PV ratio is denoted into percentage, which is 20% in case of our example. So now friends, today we are going to learn in the second part about the concept of break-even point. According to the BP, that it is the level of activity at which sales revenue is equal to total cost, both fixed and variable cost. So according to the BP, that means break-even point. What is the break-even point? Where total cost is equal to total sales. That means sales and cost are equal. This indicates that there is no profit, no loss situation. BEP is that volume of sales or production where there is no profit, no loss. Total sales and total cost is one and the same, and the contribution equals to fixed cost. BEP, which is known as break-even point, it is the point of production level where in case of production at that level, the company will earn the profits or the revenue which is totally equal to your total cost. Hence, at that point, the company is earning no revenue or no profits. BP may be expressed in number of units or sales in rupees or in percentage capacity operation. So you can calculate the BP according to the units, according to the rupees, etc. So while calculating this BP, there are certain formulas which you have to use in your example. The first formula for calculating BP units is fixed cost upon contribution per unit. If you want to calculate the BP in rupees, you can use the formula as BEP in units into selling price per unit. Another way, if the selling price per unit is not given in the example, you can use the formula for calculating BEP in rupees, that is fixed cost upon PV ratio. So you have to check the formula according to the contents given in the example. Let's have an example regarding this calculation of break-even point. Compute break-even point from information given below. Fixed cost is rupees 3,600. Variable cost is rupees 15,000. Sales is rupees 21,000. Now from this information we have to calculate break-even in rupees, because they have not told us to calculate in units. That's why we are going to calculate it in rupees. Now, as we have fixed cost, variable cost and sales, we have to use the formula where the fixed cost can be taken. So, for calculating this BP in rupees, the formula we will take, that is fixed cost upon profit volume ratio. In the example, we already have the fixed cost, but in the example we don't have profit volume ratio. So, firstly what we will do, we will calculate this profit volume ratio. Now, for calculating this profit volume ratio, we again require a formula for calculating the PV ratio. The formula is contribution upon sales into 100. Now, again the question arises, how to calculate the contribution? As we know, according to the formula, contribution can be calculated as sales minus variable cost, which is there in our example. So, let us put the figures into the formula, which is that sales minus variable cost upon sales into 100. So, sales minus variable cost will come to the contribution, and upon sales is equal to into 100 we will get our contribution. So, how much are the sales? Sales are rupees 21,000 minus variable cost is rupees 15,000, and our contribution will come to rupees 6,000. 21,000 minus 15,000, that will come as our contribution. Now, we will put this contribution for calculating the PV ratio. Hence, PV ratio is equal to, we have just calculated the contribution, that is rupees 6,000 upon sales that we already have rupees 21,000 into 100. So, our PV ratio comes as 28.57%. So, we have now the PV ratio, we also have the fixed cost. So, it is easier to calculate the break-even points in rupees. So, we will put these figures into the formula. So, BP in rupees is equal to fixed cost, that is 3,600 upon profit volume ratio, that is 28.57%, and in this way we have calculated the BP in rupees, which is calculated as 12,600. So, my dear friends, I hope you have understood how to calculate the break-even point in rupees. Now, let us understand about the another concept under break-even point, that is break-even chart. What is this break-even chart? It is nothing but it denotes the activity level where your fixed cost is equal to your total revenue or total sales. The area above your break-even point denotes the profit, and the area below the break-even point denotes the loss. So, in the example or in the chart, you can see there is a fixed cost line which is fixed for all kinds of production, right from 0 to up to n number of units, which is fixed and which is denoted by the green line. Then there is a total cost line as well as there is a total sales line, where the total cost line and the sales line intersect with each other. That point of activity known as break-even point. So, at the unit 4 or production at unit 4, our total cost line intersect to this total sales line, and that is known as our break-even units or break-even point. Now, the color denoted by blue denotes that there is a profit, and color denoted by red denotes that loss. So, any production of activity above the break-even point, they will have profits for the organization, and any activity or any volume of production below the break-even point, we will denote the loss for the organization. In this way, we can check the profit and loss position for the organization with the help of break-even chart. Now, let us understand the next concept, which is known as margin of safety, in short MOS. It is the difference between the total sales and the sales at break-even point. So, margin of safety is nothing but the difference between total sales and the sales at break-even point. It is the amount by which the current volume of sales exceeds the break-even volume either in units or in rupees. Means by which amount the total sales exceeds the break-even sales can be denoted by the margin of safety. A high margin of safety indicates soundness of the business, and low margin of safety indicates high fixed cost and low PV ratio. So, if your total sales are more than your break-even sales, that means you are at a profitable position because you are earning more revenue by having more sales. And if the sales are less than your break-even sales, that means you are losing the concern and you are losing the profits. That means you are bearing the losses. Then there are the formulas for calculating this MOS. The first formula is MOS in units is equal to actual sales in units minus break-even sales in units. Another formula for calculating margin of safety in units is equal to profit at selected activity upon contribution per unit. The third formula which is associated with margin of safety in rupees. The formula is profit upon sales minus variable cost upon sales. So, in this way we can say that there are formulas associated with calculating MOS in units and rupees, and also another one is for calculating MOS in percentage. So, for calculating MOS in percentage, the formula is actual sales minus BEP sales upon actual sales into multiply by 100. Let us understand how to use this formula in particular example. While calculating any example, you have to select the formula which has given in the example or which figures are given in the example. So, let us understand this with an example. Calculate margin of safety from the information given below. Sales rupees 1,50,000, variable cost rupees 1,20,000, fixed cost rupees 15,000. So, calculate margin of safety by having sales, by having variable cost and by having fixed cost. Let us start with the answer. MOS is equal to actual sales minus BEP sales. So, for that purpose we require to calculate BEP sales, because in the given example we only have the actual sales but we do not have the BEP sales. So, first we require to calculate BEP sales in rupees. What is the formula? We have just learned the BEP sales in rupees, which is the formula is fixed cost upon PV ratio. Again, now for calculating BEP sales also we have the fixed cost but we doesn't have PV ratio. So, we need to calculate PV ratio first. So, how to calculate PV ratio? It can be calculated as contribution upon sales into 100. But the question arises how to calculate the contribution. So, we have the formula for calculating contribution, that is sales minus variable cost. So, in our given example, we have the sales of rupees 1,50,000. We also have the variable cost of rupees 1,20,000, and with the help of that we can easily calculate our contribution. So, rupees 1,50,000 minus rupees 1,20,000, our contribution came as rupees 30,000. We will put this contribution in our formula and we will get our PV ratio. So, the formula is contribution upon sales into 100. We just have calculated our contribution, that is rupees 30,000. we have sales that is rupees 1,50,000 into 100, and by this way we got our PV ratio which is 20%. Now we calculated the PV ratio, we have the formula for calculating BEP, so we will put this percentage into our BEP formula. So this will use in calculating the BEP sales. We will have fixed cost of rupees 15,000. So fixed cost upon PV ratio. Fixed cost rupees 15,000 upon 20%, which is our PV ratio, and we have got our BEP sales of rupees 75,000. Hence, margin of safety can be calculated by deducting this BEP sales from the actual sales. Let's see, we have calculated various formulas for calculating MOS, which includes first of all the PV ratio, which also includes first of all the contribution, thereafter BEP sales, and lastly we will calculate our margin of safety. So the formula is actual sales minus BEP sales. So our actual sales are rupees 1,50,000, our BEP sales are rupees 75,000. By deducting this BEP sales, we got our MOS which is rupees 75,000. So from this example, you can see that when the total sales are more than your actual sales, which are more than your BEP sales, it denotes the profits for the organization. If your total sales are less than your BEP sales, it means you are suffering the losses. Whenever the actual sales are more than the BEP sales, it represents the profitability position of the organization. In our given example, it is likely double the BEP sales, hence our organization is in profit. So in this way, you can say that margin of safety can denote the profitability position of the organization. So in this today's session, we have learned about the three concepts, which is profit volume ratio, which denotes the profitability position of the organization by using the contribution to the total volume of production. Secondly, we have studied the break-even point also. Break-even point is nothing but the point where total cost is equal to total revenue. That means this is the point where there is no profit, no loss. And lastly, we have seen the concept of margin of safety, which is nothing but the difference between your actual sales and your sales at break-even point. When your sales are more than your break-even point, that means your company is earning good profits. So in this way, we have the formulas which can be calculated as to check the profitability position for the organization. In these sessions, we have learned about various concepts. Firstly, what is marginal cost, what is marginal costing, how to calculate contributions, then profit volume ratio, thereafter break-even point, and lastly margin of safety. In the coming session, we will calculate some practical examples using various marginal costing formulas. Thank you all.